Hi, this is Randy Finney with the right side of the chart, and today is Wednesday, October 3rd, 2018. This is the second market update today. Probably pick these up in frequency. I still think that we are potentially poised for a pretty big move in the market here. And again, these are the levels we watch. And I know this sounds repetitive, but I'm continuing to watch these levels. We still have couple sectors and the broad market really just hanging in there. But I wanted to update this. And what I'll do in this video is just quickly touch on the broad markets. I already covered that once in a video earlier today. Touch on that. I want to make mention TLT. Somebody just asked in the trading room, hey, what's going on with TLT? I want to reiterate my scenario that I have for TLT and my outlook there. And then, time permitting, I'll just run through the sectors of the S&P 500. As I talked about earlier this month and several times since, we just had one of the biggest sector rebalancings in decades, really. They've eliminated the old telecom sector. We now have the new communication service sector, but the S&P 500 is still comprised of 11 sectors. But even those that were the 10 that weren't changed are still they've been rebalanced. So I'll go through those charts real quick, time permitting. That's only 11 charts, and we'll wrap this up. Let's see. So this is starting out here. This is the S&P hourly chart, 60-minute chart. Again, I covered it earlier. Here's the trend line, the minor trend line off the late June lows right there, the yellow trend line. Breakdown, back testing so far, a lot like QQQ. So this is a market that seems to me it's clinging on. We've had these breakdowns, but again, I see primarily tech holding it up. Tech's not the only thing out there. Sometimes tech will go down a day, and financials were up today. But again, I'm looking at the major indices cracking. We are no IWM's already broken down. We already hit our first target on that short trade, and SPY. On this 60 minutes broken down, but again, there's work to be done. Then this is the longer term trend line. Again, we have to go back. This comes off the early April lows. That one still needs to go to really put the nail in the coffin. That's just right now my near-term swing target if and when this breaks. QQQ, 60-minute chart, same story, back test. It's that same trend line. It goes all the way back there to early April, I believe, and back testing, and rolling over. But really, that's the story. We continue to climb, and as I pointed out in a video this morning, from where we were, this is over a month ago on August 30th, QQQ is trading below where it was. So it's frustrating, if you are looking to short this market, waiting for a sell signal, already short. The market's gone nowhere. It's actually lower, at least QQQ is, than where it was over a month ago. And if you're long and bullish, well, you haven't gone anywhere in a month if you were long at this point. So it's really a stalemate, if you will. And again, not uneventful days. 0.16 is we're just in this slow grind period. But from these periods of low volatility, often come sharp moves, and that's why I'm doing this video. In fact, the mental image I have on this market with all these trend lines that we're flirting with just above, especially on the daily and weekly charts, I view it as one of those coin pusher machines like this, where you have all the quarters, you pop a quarter in, and you've got everything piled up. So this to me is the market right here with these trend lines. And I think when enough quarters pile up, in other words, when those trend lines break, I think it'll be pretty quick, and you'll see, what happens here. You get a dump of these quarters all come down at once. I think that's what'll happen with the market. So right now it's ho hum every day. There's really not a lot of action, some intraday price swings, but we're not seeing big moves in the market. But that's a visual I have in the market right now. So I'm going to keep doing these updates unless this precarious technical position that we're in dissipates, and markets move back up, take out the divergences. Real quick, let's look at the futures. NQ, again, this was covered this morning, has broken this minor trend line. There's the longer term trend line, goes to the left of the chart. Breakdown, back test, but we've had a lot of whipsaw signals, and that's why what I'm trying to get at here is I'm holding off on any other index shorts, and a lot of and even some of the short trades I'm sharing in the trading room that are unofficial trade ideas, semiconductors, AMD, things like that, because of these whipsaw signals. It's been a tough market. Again, it's not going anywhere. You can see the NQ futures are down, the E-minis from where they were back here, and this goes all the way back, to the end of August. So there it is. So, right now this is in a, NQ, the E-minis are in a precarious position. Technically, they've broken down, they've been back testing. But then, of course, on the other hand, we have the SPY, and this is more representative of the stock market. You have 11 sectors, much more diversified than the NASDAQ 100. Here's along that trend line. Again, 60-minute chart, and we're very close. You can see we're just right above it. It wouldn't take much, and if we break that and then we break these levels, I think we can have a quick, sharp thrust down here. I think volatility to expand. I think we'll have a 2% plus down day if we get it. But you just have to be patient. You know, it looked like we'd get it here, 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 and it hasn't happened. So that's that. And let's look at some other things. Okay, here's TLT, and I have updated this in some recent videos, at least one, if not two, but I've also, a lot of the analysis I post, the majority is in the trading room. So for silver members, if you're watching this video and you haven't seen my recent comments and analysis on TLT, I remain intermediate term bullish on bonds. What does that mean? Well, short term, the trend's down. So that's short term. And that short term is days to maybe a few weeks, intermediate, a couple weeks to a few months, several months. There's no hard line. And then long term is typically, 6 months to a year or more. That's typically long term, roughly. So what I've mentioned in the trading room, and again in recent videos, is this is a daily chart. This is a 2-year daily chart, and my take on what I think is happening here and what may happen, this is what I predicted recently, is this is a very well-defined support level. This is around 116.50, give or take. Called about 116.25 up to 116.50. There's a few lows, but look at all these reactions. TLT has been for 2 years hitting this level and bouncing every time. Today we broke down, made a clear breakdown, and it's very impulsive. That's a big move for government bonds. Not a whole lot, but a 2% move in bonds is a pretty good size move. My take on this, and again, this is what was laid out as a potential scenario. It's a flush out move. I think some short-sighted traders that only live in the day, focus on one time frame, daily charts, are seeing that. Stops are being hit. People are selling that were long. Shorts are piling in, saying this is a major break of support. And by all accounts, that's usually what you want to see. If you're going to short something, you see a well-defined support level, it's broken, an impulsive breakdown. But I also always keep an eye on the longer term charts, even if I'm trading off the dailies or 60 minutes. And this is my scenario here. So here's TLT from a 10-year perspective, weekly time frame. We had a big divergent high right here. And again, these divergences work. They're not all marked up, but you look at that, look at the high back then. It was clearly indicated by the negative divergence. If you were long TLT, you didn't have divergence here. You had a little kickback, but then boom, a divergent high. Here you had a divergent high. And again, these are the biggest corrections that TLT has had in the past, decade we're looking at. And they were foreshadowed by negative divergence. Just like right now, and what my scenario is laying out now, it's still unconfirmed. So we had this trend line. This trend line was broken, and this gives me some pause because that is a pretty important trend line right there, and it was broken. Looks like we consolidated under it. So I'm not betting the farm on this scenario, but it is my preferred scenario, and that is this. So the long-term or short-term traders watching daily charts are seeing that 116.50 level I just showed you. But when I look at this chart, and these are levels I've had, I have a support zone that runs down for about 115 up to that 116.50. And why is that? Well, you can see a lot of reactions here at the 115 level, reaction high there at 115 level, reaction lows there at 115, a big gap there with the top of that gap at the 115 level. So this is, two support levels in close proximity. I refer to as a support zone. So to me, yes, TLT is broken support on the daily, but I always give a higher weighting to the longer term, the time frame. The weekly charts are more significant. The support levels mean more. The thing about weekly charts, when you trade off them, all that matters is a weekly candlestick close, an intra-week break, and it would play in well to my scenario. It gets those shorts coming into TLT, gets the longs, the week-ended longs shaken out. And so they can take it as low as they want intra-week. But if we close this week, or even sometimes you get a week or two closing below 115, but then we snap back above there, that would be pretty darn bullish. That would be a bear trap, false breakdown, especially if we get back above 116.50. You get back above 116.50 after today's action, you will probably see a flood of shorts covering that shorted this breakdown. You'll probably see some more longs come back in once they see that level was successfully defended, once they see this was a bear trap. Again, it's just a scenario. This is only part one of my scenario, was that breakdown. And now what it's done here, and I had this yellow line in the recent videos and updates. See, that shows us, connects to these lines here. That's a downtrend line that shows a potential divergence. Now we need to see the PPO turn back up. That is right now, again, what I call potential divergence because the PPO is a trend indicator and the RSI, and they're both headed lower right now, saying that the trend is down. We have zero signs of a reversal. So part one is that flush out move, but part two, of course, is a reversal and need to regain 116.50. And doing so, if that can spark a short covering rally, that will turn the PPO back up, confirm this bullish divergence. And so as you can see, we'll have the first bullish divergence on the weekly time frame. I don't even, I'd have to go through his chart. I don't see any here on the weekly. So that's a big divergent low. Also, and again, these are just scenarios. They haven't played out yet, but I'm, ready for it if it happens. This would mesh well with my, my prediction or scenario that we're probably going to see, or we very well may see a pretty sizable correction in the sometime in the fourth quarter. That means up until from now, beginning October to the end of the month. Those are the last 3 months of the year. That's Q4. That would be that would jive with this. Why is that? Well, Treasury bonds are the king of flight to safety instruments. In fact, Wall Street Journal today put out a chart. It was pretty interesting that showed the three flight to safety instruments: gold, um, uh, treasury bonds, and gosh, I'll have to look that up. I forget what the other one was, but and they showed their correlations. The three usually on down days move up together in tandem. That's where institutions and individual investors flock to when there's market volatility. Stocks are dropping. They put money in treasuries because they're safe and typically gold. But this year in 2018 has been the lowest correlation between these three. But maybe rambling a bit here, digressing. But the point is that TLT has always been and most likely will continue to be the king of flight to safety instruments. And so, therefore, if you have a market correction anytime especially anytime soon, that would certainly play out. And what I've drawn here is a falling wedge pattern, so that would mesh very well. So these two scenarios, although they can be mutually exclusive, most likely one will hinge on the other. Just like my analysis on gold, possibly putting in a major bottom here, is highly contingent on the dollar putting in a major top. So this TLT scenario would most likely mesh with a correction in the stock market. Why? Well, not only the flight to safety instrument, but if the stock market drops 10, 20%, in heading into the end of the year or into the start of next year, well, that's also going to reflect consumer confidence is going to go way down. That's what's been buoying. Consumer confidence is a coincident indicator. It is not a leading indicator. It's not a lagging. You can plot it with the S&P 500. Everyone's stock portfolio and consumer confidence, they go hand in hand. Stock market drops, all of a sudden consumer confidence drops. What does that mean? Well, people stop spending as much, cut back on the frivolous stuff, and so therefore economic growth forecasts will go down, therefore long-term treasury rates will go down. So it's all interrelated, and again, that's my preferred scenario right now. So part one is in play, and then we need part two, which would be this week or sometime in the coming weeks to see a recovery back above 116.50, and then of course above this downtrend line here on the weekly chart. Okay, now let's just quickly run through the new sector allocations of the S&P 500. I went on Standard & Poor's site today. I updated all the weightings. So as I go through this, if I don't mention it, you'll see somewhere on here what the new weightings are. And this just happened, so these are up to date, and that'll give you an idea. So when we're looking at XLF here, for example, this is one of the bigger sectors, about a 13% weighting. So this one matters. And you get down to basic materials, and you're talking a 2-3% weighting. Doesn't matter what they do. Even the REITs have a very low weighting, so keep that in mind. Technology, as I say, is still the largest weighted sector. So we'll run through these real quick in no particular order. XLF, this is a daily time frame. Here's a minor a price channel here. We had this, wedge type pattern, a downtrend line we broke out. I mentioned this. We've been moving higher since, but very anemic rally. You can see not very impulsive since the breakout, but yeah, moving up. And then here was an uptrend line. We zoom in a little bit. So there's that channel. We broke down below it. Now we're back testing. And this 28-27 level was resistance in the past. If you go to the left of the chart, you'll see there, all the levels that mark that as resistance. Even though we've chopped and traded through it recently, it may still come into play. So basically, we have a breakdown here on XLF of this trend line with two resistance levels to overcome, both that trend line, it may backtest for a while, and then 28.27. And we had negative divergence at the high. So that also puts me, my expectation is that we will fail and continue lower in XLF. I'll try to jump to the weekly charts on there. There's a weekly chart, 2016 uptrend line has been broken in the financials. And, like most of the market, it's just trading sideways since. It hasn't gone down a whole lot, but it hasn't gone up. Financials topped back in January, the beginning of the year, like a lot of other sectors. So many sectors in the market have topped. Some haven't. It's, again, mostly technology and a few other things, and just really a handful of stocks, the big FANG stocks, carrying this market higher. XLC, this is the new communication sector. This is what replaced the old XLT. Telecom is really, there's no more, phone lines they're still around, but those companies now are much more diversified. So this is the new XLC communication sector. I usually like to see at least 1 year of trading history on a chart to get a feel for it. And since this is a new sector, the ETF is new, this is a daily chart, you don't have much. So all I can do in that case, I go down to a 60-minute chart, look at more recent history, and we're starting to get some levels here. I won't spend too much time on it, but you can see why I marked these lines. We have a cluster, there's a gap, failure again at that gap, reactions here. So $50, 50, call it, this is 50.01, call it 50. And then I have reactions here, reactions here, reactions here. We popped above it briefly, but we failed. A couple more reactions, so 49.17. So these are my overhead resistance levels. Here's a potential trend line. And more importantly, for a downside break, for a sell signal would be, well, you want to see a failure here, here, or here. But then a break of this is our most recent uptrend line, and that's on the 60-minute chart. So there's not a weekly chart to look at because, again, this is a new ETF. So let's go out back to the next one. Here's the big boy here, the 800-pound gorilla. XLK, 21% weighting. It's come down a little from what it used to be. Probably a smart move on Standard & Poor's part because they probably realized once this tech, I don't want to call it a tech bubble. Tech companies are leaner than most other companies in the S&P because they're cash flow positive. They're cash rich, I should say. They don't, they only have debt. Companies like Apple, only because rates were so cheap recently. They didn't need to sell bonds, but they did because they could and get such a cheap interest rate, and they used it to buy back their shares. So great strategy, but like all things, it's only going to go up so much so far. And most importantly, we can talk fundamentals all day long, but technicals really rule the day, in my opinion, by far. Much more accurate predictor of where stock prices are going, especially if you want to time your entries and exits. So this is the uptrend line right here on XLK off the April lows, very, very well defined. And as I've been saying for weeks, if not months now, the market doesn't break until tech breaks. It's just the way it is. It's over 1/5 of the S&P 500, and last check, it was over 60% of the NASDAQ 100. So that's it. There's no two ways about it. Unless tech breaks, market can certainly go down if all the other sectors fell, but this is the one I'm watching. So there's sell signal number one, and impulsive break and or close below that trend line. And then we have this secondary trend line that may come into play, and I'll keep you updated. Divergences tell me, that it's probably only a matter of time, just as these divergences built and continue to build. And we had a little shot across the bow, one correction, pushed up, made a second divergent high, and then had another sharp correction. So until and unless these divergences abate, meaning they're burned through, I'm still looking for a break of this trend line, and most likely soon here, almost certainly by the end of the year, and it could come any day now, any week now. Weekly chart, this is long-term stuff. Here's a trend. What happens when these trends get very long in the tooth? Everybody's bullish. No one's shorting anymore. Everybody wants to own stocks. You have these mini crashes, and that's what happened. XLK, that tech sector ETF, I'm going to rough estimate this drop 28% in relatively short order. And you can see it came right after that trend line break. Here's a comparable trend line, just as well defined, 200-day or 40-week moving average not far below, a key level as well. So when you see this trend line break and that 40-week EMA go, in my opinion, it's lights out for XLK, lights out for the market. But until then, the trend is your friend, and we're still above trend. So no sell signals there yet. XLE, energy sector ETF. I did a update on crude oil today. I think crude's it's certainly at significant resistance. And again, you can check out that earlier video, but this is a big level, 78.50-ish on XLE, energy sector ETF. And if crude rolls over soon, we may or may not get there, but we're close enough. But anyways, I see significant resistance there. If we break it out impulsively and stay above it, anything's possible, but I just want to point that out. We'll probably pause, have at least a consolidation, if not a pullback when we get around there, if we get there, and it's not far away. Weekly time frame, negative divergence says, and you can also see that there's a resistance level there as well. That's XLE. XLI, industrials. This is a weekly chart. I kind of just skipped over here to weekly. We'll go to the daily in a second here. Potential divergence. It's not yet confirmed, but we did break this long-term uptrend line in 2016, and like a lot of other things, industrials topped back in January, still below their all-time highs, and here we are heading into the last quarter of the year. So here's another sector that has already peaked, and it didn't just peak and another correction. It broke a long-term trend line and it's still below that trend line. If it pushes higher, you can see I have a little room here on this divergence line. Let me move it up here. There's the previous highs right there on the previous highs. So any push up to that level or higher will be guaranteed to have negative divergence. So in other words, XLI cannot make a new high in the next couple months without putting in negative divergence. And trend line breaks are one thing, but when I see divergence as well on a weekly, that's usually what ends your big trends. You had divergence at the last high, last time the industrials broke down. Remember, these were just corrections within a bull market. So. And let's just say we're only looking for a correction now. That's still going to be, on XLI, come down to this trend line, probably a minimum 6% drop. Next one up, XLV, healthcare. That's a pretty good size weighting, about 15% in the S&P 500. Here's a minor trend line to watch as we diverge higher. A lot of price compression going on here in XLV. There's your divergence lines. You almost have to zoom in there to see them. But that's it. So not much to say other than watch this trend line. A break of that could give us a sell signal. This one is at new highs, this sector. And there it is on the weekly chart. I think I gave you there's a long-term. That's the long-term. This is your bull market trend line. Comes off the March 2009 lows. So we're still comfortably above that for now. And at minimum, I think we'd get at least one more reaction if we fell from this level and hit it. But again, we have other sectors and the market much closer to those long-term bull market trend lines. So sometimes if everything else is breaking down, you get a broad-based sell-off, and it's possible that healthcare comes and smashes down through that. Again, if we get a broad-based sell-off anytime soon. XLY, consumer discretionary, 10.24%. This one's broken down. This is the one that Amazon is by far the largest component of, and Amazon, is a key stock in the S&P 500 and the Nasdaq as well. And there's a big red impulsive candle. Day 2, we're still trading below it. So there's a sector on breakdown, in my opinion. Probably offer an objective short. My only pause here, and the reason I haven't added it, is I want to see the broad market breakdown. And we've had enough whipsaw signals. Shorting in such a resilient uptrend has proved to have a higher than usual number of short trades that have failed. So again, better be the second mouse on this one than the first. Second mouse gets the cheese. But there it is. If you ask me if I had to be long or short right now, be short. And with a stop not far above the highs. But let's just give that one a little more room and then look at it on the weekly chart. There's your bull market uptrend line, divergent high on the weekly chart, just like we had divergent high here, 11% drop, divergent high here, 18%, divergent high there, 17%. I see no reason, well, at least I see a pullback to this trend line, I should say. And that would be, what is that? About a little less than 10%. So that's a weekly chart of XLY. And I can wrap it up here most likely. Here's XLRE, the real estate sector ETF. I use IYR as my charting proxy because it's been around longer, but XLRE, because this is the spiders. This is the one the S&P uses, and it's only a 2.62 weighting. So again, it's not going to have a huge impact on the market. But we're short this one. We shorted the REITs when they broke down. We just hit the first target on SRS, which is a 2-time ultra short. But what stands out to me, and someone asked today if they thought we should cover. It stands out is it looks like a bear flag right there. There's your move down, an impulsive move. Bear flag is a continuation pattern, and the measured target. You take the length of the flagpole, measure down to the bottom of the flag, add it to the top of the flag, and that would give you a target, and it comes in around that 3120 support level that I have there. So that's food for thought. And then just look at IYR real quick. There it is, same thing, flagging type action. We broke support. In fact, we were here today, and my response to someone in the trading room had asked, do you think the move down, at least for the near term, is over in IRR where we're going to get a reaction? And I guess implying maybe should I cover the SRS short? Um, my answer was, a reaction is likely there because you're at support. But however, we already had the first reaction there last week, last Wednesday, and I always say it's the initial tag of support from above that usually produces a reaction. So there it is. Um, Okay, sorry, I had to pause the video there for a brief interruption. So, anyways, my thing was that we usually get an initial a tag off the initial reaction of initial tag of support. I'm sorry, a reaction, meaning a bounce or a consolidation, and that's exactly what we had. So that was my response, that we already had the bounce. There was our reaction there, and so while we could, certainly could bounce again, the odds are still high where you're at support. Um, there was our reaction, and therefore we're probably going to go down and hit the next target on SRS. And again, at the time, that was a couple hours ago, we were sitting on that support. Now we broke support, and it looks like that flag's playing out. So that the takeaway was, no, I would ride out any counter trend bounces, is what I said. And there it is. So we had a divergent high there in IYR, and look what happened. We just had a divergent high at the same level, failure, breakdown of the uptrend line. And so we can easily come back down here. Now, it's not a big move. REITs are not going to, put a lot of money in your pocket quickly. 3% maybe downside to that target's hit, but you can also leverage it up. It cuts both ways. When you trade a low volatility instrument like government bonds, obviously you can put a lot more in than you would into GDX, let's say. So here's the SRS trade. There it is. You can see we hit the first reaction. The first target had a reaction, a pullback, and now we've taken it out, which was resistance, and that opens the door up for a move to T2. Next up, XLP. We're almost done here. XLP is a consumer staples ETF. You can see the chart. Look at these divergent highs, negative divergence, divergent high, divergent low. And that's it. It's, nothing's 100% in trading, but I like to use a pretty simple but effective trading style. Looking for the swing trade, the divergent lows, position to go long. And the divergence is not a buy or sell signal. It's these trend line breaks or other buy and sell signals. That's your signal to get short. You come down, for example, here we fell to support. You can see that support line. The reason I had it there, a lot of reactions, and boom, that's what ended that downtrend. We also had positive divergence, so that should have put you on alert for a breakout. And again, this is what we call swing trading. This is not trend trading or investing. Is just swing trading these rips. You can call that trend trading if you caught the whole thing, because that lasted 6 months or so. But and you can see, so you had a downtrend line to take it taken out, and you could probably draw an uptrend. That's not a great uptrend line. There was probably a bearish engulfing candle, some type of bearish reversal stick up there at the top possibly. But either way, a divergent high. You could see the negative divergence building. And that's another thing I talk about a lot. And I know I'm going all over the place here, but I talk about this in trading all the time, that on face value in trading, you read any technical analysis book, breakouts to new all-time highs or multi-year highs, 52-week highs are bullish on face value. Why? Because at that point, everybody long the stock is profitable. There's nobody underwater, so you don't have any remorseful holders waiting to get out of the stock. Just like a break to new lows is very bearish. Everybody's underwater at that point. But so they tell you, a lot of traders buy new highs, and very often I will, but I don't buy new highs that have negative divergence. This was a breakout. You can see we had tested, and boom, breakout to new highs. It rallied, and I say this often, breakouts that happen on to new highs with negative divergence have a much higher rate of failure, and when they do, very few things in trading are more bearish than a failed alongside breakout. And you can see that very impulsive slide after that breakout failed, and we continued down. Okay, sorry, one more interruption there. Just pause it for a second, and that's it. So again, watch, rinse, repeat. That correction ended in a divergent low. See the positive divergence down here, and boom, that gave us this rally. And this, so far, this one ended with, you got it, a divergent high. We had divergence at that point. I just added the second divergent line. We popped up, made one more high here. That first divergence was good for a little pullback. We kicked up again, and now we are at support in XLP. And XLP is about 7% of the S&P 500. So there it is. And I would be remiss not to look at the weekly chart here. Here's a trend line, pretty well defined. It doesn't come off the 2009 lows because it just didn't fit. But I have this trend line here with a lot of reactions, and of course, big divergence high on the weekly chart. That's more significant. You know, these are multi-year divergences that span a year and a half or so, and that usually indicates a more lasting trend reversal. So we broke trend, we back tested, we came down, hit this first support here, have its two support levels close by, and this looks like the initial kickback rally of a new downtrend following a break of that primary downtrend line and divergent highs. So this would be wave one down, wave two, maybe a wave three to come on a possible five wave, or whatever if you want to count the waves. But either way, we're starting to roll over now in XLP, and I just showed you the daily chart, which also confirms that the near-term outlook is bearish. And finally, XLU, again, you're not going to get rich quick going long or short unless you leverage up, because utilities don't move much. They're steady Eddie dividend paying, recession-proof stocks. But they, last bull market, they rolled over before, they topped before the market as well. And there's a pretty well-defined uptrend line. This is your bull market uptrend line. This isn't a 60-minute trend line or a daily trend line that goes back a year or two. This is a decade-long bull market trend line, pretty well-defined, big divergent high. It was broken and back tested. So these patterns, in my experience, and I've traded them for years, they work no different on a 60-minute time frame or a weekly time frame or even a monthly time frame. The technical analysis, the same premises apply, and that is, you have a trend line break, a back test, and this would be my expectation. Nothing's guaranteed, but from looking at this chart, I don't see a single thing in there that doesn't tell me that we're not going much lower in utilities. In fact, I recently did a video where I talked a lot about using the PPO in various formats for, buy and sell signals or confirming, and you have now a bearish cross. It's coming down quick as we're rejected here. So I like to see that as well. And so again, this has all the appearance to me that we've just completed the first counter trend rally of a new downtrend that started really here off the highs and then was was confirmed once we broke the primary trend line. That's XLU. And again, not a big component of the S&P 500. It's not going to do a whole lot, 2.85%. And there's XLB, only this is basic materials, about 2.5%. What I have here in the daily chart is this is my main uptrend line, but I have this benefit of the doubt trend line, this yellow trend line. So just watch for a break of that. Put it a little bit easier. Just watch for a break below Friday's lows, and that would most likely trigger a sell signal in XLB. Other than that, you can see some overhead resistance levels if the basic materials hang in there, and that's what the weekly chart looks like. So there it is. There's that trend line I just showed you on the daily, but you can see it here on the weekly chart. Okay, guys, it's a long video, but I got a lot in there. We covered all 11 sectors in the S&P. Remember, put an emphasis on the heavier weighted sectors. They're going to have more of a bearing on what the market does. So watch for technology first and foremost. And even if you don't agree with my analysis, that we're in a very precarious position in the markets and we could break down, have a sharp sell-off, all those levels that I put out there are support levels that I'm watching to confirm a short entry on some of those sectors of the market. Whereas you can use those same levels if you're bullish to buy dips on pullbacks. So you can look at it either way. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.